What's been making headlines in finance and economic news this week? We're talking with Suzanne Haddan, Managing Director at BFG Financial Services. Suzanne, thanks for being here.
Good morning.
The RBA has some thoughts about the Australian economy.
Yes, none of them great, are they? So we had the forecast GDP now 1.7% for 2019, which is almost 50% or half of what it was announced 6 months ago. And why? One of the things is consumer spending. Not much growth there, and that represents 60% of the economy. So that's a bit of bad news. And of course, our property prices dropping, which is making consumers feel they don't have as much wealth to spend and enjoy themselves.
What does this tell us about interest rates?
Well, we all thought interest rates would come down last week, and they held off. And the forecast now is potentially 2 interest rate cuts, totalling 0.5%. So it brings us down to 1%, which is just unbelievable. Although that probably won't have a great effect for the property prices because we're already low interest rates. It's the fact that people can't get a loan to buy a property that is one of the major effects there. But it could put more money in people's pockets, and that's what they're looking for.
I saw some people speculating as to why the RBA didn't cut rates this week, given that we then saw this forecast from them later in the week.
Yeah, do you think it might have been a little bit of a political? They don't like to do that in the middle of an election campaign, so I'm sure that weighed on them. And unemployment is still acceptable around the 5%. If you see that go up, I think you'll see interest rates come down.
There comes a point at which you can't really lower them anymore. If you're talking about an interest rate of 1%, then, presumably one of the mandates of any reserve bank is to make sure that they still have a few bullets left, just in case something bad happens. If the world plunges into another recession, for example,
Correct.
you want to have some... Is it risky to leave themselves with nowhere to go should things turn worse?
Well, Josh, I think with interest rates, yes, that'll be tricky for them at 1%, but they still have quantitative easing where they sort of get themselves involved in markets.
You can call it printing money. That's what most people call it, printing money.
That's basically what it is, isn't it? And maybe spell it right.
Yes, responsibility for spelling it right. We just spoke to James Glenday about the US-China trade talks. It seems as though a deal hasn't been settled yet, but let's look at what this means for Australia. China is Australia's biggest trading partner, $195 billion per year. What could be the potential fallout for Australia?
In the short term, it can seem that we could get a benefit, say our iron ore going and more competition for us since the US might be out of the game a bit. But what happens when you have things like the trade war? It's actually bad for the global economy. It creates inefficiencies, people change their patterns of spending, and it means people produce things that they aren't necessarily good at because the tariffs make the other competitor product higher. So I think it will drag our GDP over time for sure.
Well, so the President has been talking about imposing tariffs on China as if it is punishment for China. Just in case he's watching, can you remind the President of the United States who pays tariffs?
It is the American consumer. It's forecast that with the proposed tariff increase, we had some yesterday on $200 billion, proposed on another $325 billion, that it could be a $770 per family deficit for the American consumer because it's extending to things they buy at their local Walmart. So it is certainly bad news for their consumer.
Not to mention the retaliatory tariffs that China has then imposed on US goods, which are hurting many of the people who voted for Donald Trump in the heartland.
Yes, so we've got to sell a lot of soybeans to make up for that. But the other thing to remember is, why is President Trump doing this? It is not just about the trade deficit because it's 1-5 in favour of China. They're also trying to send a message about their stealing any know-how, about supporting the Chinese companies over all else that are privately owned there, and also the global supply chains that are pushing places like Apple and big companies to produce in China. Trump wants to bring that back to the US. So there's a lot of messages in there.
And this is really something that the Australian economy doesn't need at the moment, given that it is quite soft.
We don't need any shocks. And you look at the stock markets, I mean, last week was not a good week. They're just reacting to rumours and tweets, and when it involves President Trump, that's really dangerous. I saw them react when the Chinese delegate waved the US market went up. I mean, that's really desperate.
What about the R word, though? Are we that far down, the word recession?
Oh, no, Joanna, we're not down to recession. No, let's be positive.
Okay.
And there are some good things in our economy. So we'll remember those, I think.
Are the forecasts about the Australian economy going to make an impact on the expectations for surpluses and deficits that we've been hearing from the political parties? There are lots of prognostications. I remember the Treasurer, Mr. Frydenberg, standing up there and talking about how we are currently in surplus next year. Yeah. Next year we are currently in surplus. Is that going to have to be rejigged on the basis of our subsequent expectations about growth?
That's important, Josh. There'll always be rejigging. We just spoke about the RBA getting the forecast wrong from 3.25% growth 6 months ago, and now we're forecasting 1.7%. So it highlights the problem of long-term forecasts. It's not that anyone's doing anything wrong, it's that other factors like the trade wars can have such an impact on GDP. Numbers have to be rejigged, and they are. Generally in December we get the mid-year forecast as well, so watch that spot.
Something else interesting in economic news is the debut of Uber on Wall Street, and it's opened lower. What do you make of that?
We're calling it the Uber belly flop because it's actually 8% lower than the issue price of $45 per share, which was at the lower end of what Uber were hoping for last year. And what happened was another company, Lyft, listed as well last year, and they're down 30%. So that didn't augur well for Uber. And could they have picked a worse week in recent history? So they've certainly suffered, but it is an unusual platform. It's not just ride hailing. You know, they're doing Uber Eats, they're doing driverless cars, so they want to be the platform of choice, and hopefully that'll be more sustainable.
Suzanne Haddan, we'll have to leave it there. Thanks for coming in.
Thanks.
Thanks, Suzanne.